Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 21 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for our 21st session on mutual funds versus fixed deposits. So let us begin with our learning session today. Many of you may be quite familiar with the traditional investment instrument that is considered safe and caters to the needs of large category of investors in India even today. Being a financial instrument provided by banks in India, it offers returns better than regular savings account and hence enjoys an edge when it comes to earning better returns on one's savings. Yes, we are talking about fixed deposits. It usually ends up in a long debate when it comes to comparing fixed deposit with other investment instruments like mutual funds. In our learning session today, we'll try to present a clear and an unbiased comparison which may help you choose a suitable investment avenue, that is mutual funds or fixed deposits, to meet your financial goals. So let us see which of these are more advantageous, mutual funds or fixed deposits. First, let us take a look at what are fixed deposits. Fixed deposits are a traditional financial instrument offered by banks. Fixed deposits provide rate of interest higher than regular savings account. Banks compensate you for committing your money with them for a longer time period. They offer fixed rate of interest for a pre-specified tenure, so you will continue to enjoy the same interest rate throughout the tenure. Such interest rates may vary from bank to banks, ranging from 4 to 10% or sometimes even higher. Generally, the longer the term of the deposit, the higher would be the rate of interest offered by the bank. Fixed deposits come with a predefined maturity period. You can fix your money at a higher rate right from 7 days to as long as 10 years. But there is a restriction on withdrawal of the money before maturity. Banks may charge a penalty for premature withdrawal. Say you invested in a FD offering interest at the rate of 9% for 5 years, but due to some emergency, you need to withdraw the money after 3 years. In this case, the bank will pay you interest applicable for 3 years of your investment tenure, leaving with you a lower interest rate of say 7%. So you would lose 2% on the returns and maybe additional 1% in the form of penalty for premature withdrawal. Fixed deposits are considered to be safe investments as they are covered by the Deposit Insurance and Credit Guarantee Corporation (DICGC). However, DICGC guarantees an amount of Rs 1 lakh per depositor per bank for both principal and interest. It is noteworthy that deposits kept in different branches of a bank are aggregated for purpose of insurance cover, and a maximum of up to Rs 1 lakh is paid to the depositor. Apart from fixed deposits, banks in India also offer recurring deposits and flexi-fixed deposits to investors. While in our past session we told you all about investing in mutual funds and how it is beneficial for you, here we have compared mutual funds and fixed deposits on various parameters. Mutual funds versus fixed deposits. In terms of the rate of returns, while the interest rate offered on fixed deposits are pre-specified and fixed for the entire tenure, the returns on mutual funds may vary based on the market movement. While mutual funds offer you the benefit of market-linked returns, they have the potential to earn higher returns in the form of capital appreciation during positive market conditions. On the other hand, fixed deposits would continue to offer you the same interest rates even if the markets turn negative or positive. So usually, mutual funds outscore fixed deposits during positive market conditions and underscore fixed deposits during negative market conditions. We all know that inflation eats a major chunk of our savings in terms of loss in the value of money. So you need to keep pace with inflation. Your investments would be worthy only if they are able to offer you decent inflation-adjusted returns. Assume you have invested in a fixed deposit offering interest at the rate of 9% per annum, while the rate of inflation is 8%, your inflation adjusted returns would be only 1%. It is quite obvious that you would like to look beyond this rate. Mutual funds have the ability to offer you better inflation adjusted returns, but do not forget they come with a relatively higher risk. So what is the risk associated with these instruments? While bank fixed deposits are known for low risk, mutual funds carry market risk which is higher than fixed deposits. So you should consider your risk appetite while you're opting between banks fixed deposits and mutual funds. Also recognize that high returns come with high risk. In terms of liquidity, fixed deposits come with a fixed tenure and offer a medium to low liquidity option until you complete the entire tenure of the deposit. On the other hand, most mutual funds do offer liquidity to its investors, but with certain conditions. As we mentioned earlier, you may need to pay a penalty for premature withdrawal of your fixed deposits, where you would lose out a portion of your expected return. On the other hand, most mutual funds offer you high liquidity once the minimum holding period is complete. In case you happen to withdraw immediately after your investment, usually within a period of 1 year, then you may have to pay an exit load, which is usually 1%. Exit load conditions may vary from one fund to another, so you should be aware about the exit clause of the mutual fund you are investing in. Cost of investment and expenses. There is a cost associated with your investment in mutual funds, and it depends on the category of mutual funds you are investing in. While a liquid fund may have a low expense of up to 1% per annum, debt mutual funds may have anywhere between 0.5 to 2.25% per annum, and the expense of equity mutual funds may be up to 3% per annum. This expense is adjusted in your returns, so the returns yielded are post expenses. On the other hand, bank fixed deposits offer an advantage on this parameter as they do not levy any expense on the depositor, and you get the entire rate of interest promised by the bank. Tax status is an important aspect which you should consider while choosing between mutual funds and fixed deposits. You would agree that you would like to make high post-tax returns from your investments. In our previous session, we told you about the tax implications on your mutual fund investment. The tax status of mutual funds is based on their category. While you need not pay any long-term capital gains tax on investment in equity mutual funds, the short-term capital gain is taxable at the rate of 15%. On the other hand, your gains from long-term investments in debt mutual funds, that is over a period of 1 year, is taxable at the rate of 20% with indexation and 10% without indexation, whichever is lower. While your short-term capital gain from debt and liquid mutual fund is taxable as per the tax slab. As far as fixed deposits are concerned, irrespective of the tenure, the interest which you earn thereon is taxable as per your income tax slab. So as per the current tax laws, mutual funds are quite tax friendly provided you have held on for more than a year and you are in the highest tax slab. The illustration here can help you understand better the comparison between mutual funds and fixed deposits. Here are 3 scenarios which show an investment of rupees 1 lakh each in bank fixed deposit, debt mutual fund and equity mutual fund. We have assumed in a given year all 3 investments deliver a return of 9%. Further, the assumption is that inflation will grow at the rate of 7.5% in the given year. So you see, rupees 1 lakh invested is now rupees 1 lakh 9,000 in each of the investment avenues. But in case of fixed deposits, with the interest income being taxable as per the tax slab of an investor, the gain of rupees 9,000 which the investor earns would further reduce to rupees 6,300, assuming one happens to be placed in the highest tax slab of 30%, where he would have to pay a tax amounting to rupees 2,700. So the post-tax returns would be 6.3% in the given year in a case of FD. However, in case of debt mutual fund, with the indexation benefit available on account of long-term capital gain, since having invested for over 1 year, the cost of investment is raised to rupees 1,07,500 due to the inflation factor instead of rupees 1 lakh. Thus, considering the index cost, the taxable gain would be rupees 1,500 instead of the original gain of Rs 9,000. Here, the investor pays a long-term capital gains tax at the rate of 20% as he claimed indexation benefit, and hence the post-tax returns over a period of 1 year would be 8.7%, which is higher than the bank fixed deposit. In case of equity mutual fund, the entire long-term capital gain of Rs 9,000 made on equity mutual fund is tax-free and available to investor, proving to be the most tax efficient in the above illustration. But you should choose your investment avenue wisely, judge your risk appetite and the investment time horizon well, and understand your return expectation, which should be rational, before zeroing in on the type of investment avenue. Now, before we end our learning session today, here are some points you need to remember. Fixed deposits are traditionally a safe investment instrument that provide rate of interest higher than regular saving account. Fixed deposits are covered by the Deposit Insurance and Credit Guarantee Corporation, or DICGC, which guarantees an amount of up to Rs 1 lakh per depositor per bank. The rate of interest on fixed deposits is fixed for a pre-specified tenure. FDs would continue to offer the same interest rates irrespective of market conditions. Compared to bank fixed deposit, mutual funds have the ability to offer better inflation-adjusted returns to its investors. The returns on mutual funds are linked to market movement. Fixed deposits are suitable for investors with low risk appetite, while mutual funds, being subject to market risk, are suitable for investors having relatively higher risk appetite. While fixed deposits are less liquid, premature withdrawal of fixed deposit may be allowed with a penalty which may harm the expected returns. Early redemption from mutual funds may be subject to exit load, which in most cases is applicable for a holding period of less than 1 year. In terms of cost, fixed deposits are placed better than mutual funds. While mutual funds enjoy favorable tax status as compared to fixed deposits, which means better post-tax returns for mutual fund investors. So you should consider your risk appetite, investment time horizon, and your return expectation along with the other parameters while choosing between fixed deposits and mutual funds. So to end our learning exercise today, we now invite you to test your learning by taking up the simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.